Welcome, everyone. Welcome. It is Angelo Robles. I'm here live for those of you listening or watching live. A rare time for me at 12:30 Eastern, but hey, you got to change things up. It's a new month. Why not? I did promise last night, and I'm sure you heard my incredible 10 AI predictions for 2026, plus two bonuses. But if you didn't watch it live, you could watch it via LinkedIn, YouTube, and X just by going to yesterday. But today, I'm doing something that many of you have requested that you think I got a little bit away from, and that's really a deeper dive into investing. So this is going to be on the longer side. Going to give away my age and my era. Now would be a good time to get that Tang, that drink mix. Come on, you all know from the late 60s, 70s what Tang is. Young audience, what's wrong with you? You don't know what you're missing. These powdered, sugary drinks, all full of all these incredible chemicals, keeps you well preserved after 60 years, I might add. So today, the AI era is breaking traditional investment analysis. Here's what still works and what doesn't. So I'm also pulling this from, I've been working for you. The last couple of weeks, I knew I was going to do something on this. Besides my own analysis, I spoke to a couple of incredible billionaires, investors, family office investors, and we all kind of went back and forth. And this is kind of a collage because I do think that things are changing rapidly. And on that note, without further ado, let's do it. The AI era investment framework. I mean, I'm going to share something that's been keeping me up at night. We're living through the most significant shift in investment principles since, well, ever. And most investors are still using frameworks built for a world that is rapidly disappearing. And today I want to walk you through how I and others think about building investment portfolios in this new era. The train has left the station. It's never going to be weaker than it is right now in this current quote unquote AI era. We'll start with the foundational architecture of the investment policy statement and asset allocation. And then we're going to go deep into what's changing at the investment thesis level. That's really going to be where the juice is in this, by the way. Because here's the thing. Some of these principles we've relied on for decades, and many of them, not all, but many of them are effectively about to be obsolete. So we'll start with the foundation, investment policy statement and asset allocation. Before we get to what's changing, let's quickly establish kind of what shouldn't change. Your disciplined approach to portfolio construction. So your investment policy statement, your IPS, is effectively your constitution. It codifies your objectives, return targets, risk tolerance, time horizon. It defines your constraints, liquidity needs, taxes, regulatory requirements. Most importantly, it captures your investment philosophy in writing. When markets get volatile, and they will, and emotions run high, they will. This document keeps you as an investor and your family office, your investment committee, anchored. It also specifies your rebalancing rules and governance structure, who makes decisions and how. From your investment policy statement flows your asset allocation strategy. There's multiple types. Strategic asset allocation, kind of your long-term policy weights, making it a little broad. Think 60% equities, 30% bonds. Who the hell would do that? 10% alternatives. This is based on your return and risk objectives over a full market cycle. You would change this rarely. I don't know, maybe once every couple of years. It's your foundation. It survives market volatility because it's built on your fundamental objectives, not market timing. But many of you prefer tactical asset allocation, more short-term deviations from the strategic weights that I mentioned before, maybe equities ranging from 50 to 70%, but likely around that 60% target. This is where you exploit mispricings, valuations, and macro dislocations. It's active, opportunistic, and requires real conviction. Kind of, I would look at this as being your offense where you, quote unquote, capture alpha. Now, lately, the trend for many, including family offices, honestly has been a little bit more core satellite. Your core, maybe 70 to 80% of their portfolio, often in lower cost diversified positions that track your more strategic allocation. Your satellites, 20 or 30%, are high conviction, concentrated tactical bets. The core gives you stability and beta, but who wants only that? The satellites generate alpha. It's the best of both worlds. Passive discipline meets active opportunity. And by volume, sure, been trendy, probably more so for sub $500 million family offices. But the hierarchy is clear. The investment policy statement defines what you're doing. Strategic allocation determines effectively what you own. Tactical allocation determines when you adjust. And core satellite kind of determines how you implement if you want to get a little creative on effectively all three. Now it gets a little fun. Here's where AI enters the picture. In this new era, the tactical windows are compressing. What used to be quarterly positioning decisions might now be monthly. Your satellite positions need faster adaptation cycles, I guess I would say. And your strategic allocation itself might need kind of a new category. How about compute and AI infrastructure exposure? But really, that's just the beginning. The real transformation is happening. Now, here's where the fun part is. It's happening at the investment thesis level. So first, let's go over the traditional framework, kind of finding multi-decade compounders. We all want that. For years, I've analyzed companies through a lens I learned from some of the greatest investors on earth, kind of its 9 core lenses. And I'm going to walk you through them right now quickly, because understanding the traditional framework is essential for grasping what's about to break. And we're going to go over that too. First, moat durability. What specific mechanisms prevent competition? Network effects, data advantages, regulatory barriers, brand equity, cost advantages. Can you quantify the switching cost? What's the financial and operational pain if a customer leaves? Is this moat widening or narrowing over time? Second, cash flow characteristics. What's the percentage of revenue? What percentage of revenue becomes that we distribute? And you thought this was AI. I'm not good enough to be AI, my friends. What distributes free cash flow? What's the capital intensity dollars required to generate incremental revenue? And how does incremental revenue flow through free cash flow? This is about understanding true economic earning power. Third, the runway length and structural tailwinds. What percentage of total addressable market have they captured? How many years of growth remain? Is the market itself expanding? What are 3 to 5 irreversible secular trends benefiting this business? So those are 3 anchors, at least foundational, of how things used to be. But I got some more for you because I did promise 9. And then what's new, what got cut off, and what's adapting. So fourth, supply, demand imbalances. Kind of what limits competition on the supply side? What drives structural versus cyclical demand? Do they have pricing power? Can they raise prices above inflation? That's a big one. Are competitors structurally disadvantaged? Fifth, I used to love this one, quarter by quarter growth. Revenue growth patterns, organic versus acquired, accelerating or decelerating, cohort analysis. Are newer customers more valuable? Margin trajectory, customer metrics, retention rates, net revenue retention, LTV to CAC ratios. Six, capital allocation mastery. I love that one and I still do. Historical return on invested capital trends, incremental kind of ROIC on recent deployments, M&A track record, buyback discipline, dividend policy. Do they maintain optionality and flexibility? Seventh, founder / CEO, even management excellence. Is the CEO a founder? What's their ownership stake? How are they compensated? Long-term value creation or short-term metrics? What's their track record? Do they sacrifice short-term results for long-term value? Not good. 8, relative value and opportunity cost. Current valuation versus a kind of intrinsic value. Expected IRR over 5 to 10 years. And the critical questions, what else could I own with equal or less risk offering superior returns? Important for me to want to move money from one investment to another. 9th, kind of risk framework. What are the existential risks? Who could disrupt this? What could go or what must go right? Am I paying too much, even if I am right? I'd rate, and again, learn this from others much better than me. Each dimension 1 to 10. Synthesize a thesis statement from there. Assign a conviction level and size the position accordingly. The goal, well, finding businesses you'd be comfortable owning if the stock market closed for 10 years. Quality compounds, mediocrity reverts. This framework has worked in a long enough time horizon, kind of really for decades. But AI changes everything because intelligence is going to be into everything and change what we know. It's going to be the horizontal, it's going to be the foundational layer. So now AI era investing, what sticks, what goes, what adapts, what's new? Let me be direct about what survives and kind of what doesn't. So I'm going to start with, in this era, what sticks. The unchanging core cash generation kind of still reigns supreme where you could find it. If anything, free cash flow generation matters more in an AI era, not less. Capital light models, well, become even more valuable. AI doesn't change the fundamental truth that cash is oxygen. Capital allocation mastery remains a critical differentiator. Maybe even more important now because AI creates entirely new deployment options. Discipline still beats optimization. I still like founder CEO led excellence and management quality. Human judgment on capital allocation for now is kind of still irreplaceable. That founder intensity and obsession still compounds. Skin in the game still aligns incentives. Relative value and opportunity cost. This iron law of investing kind of survives intact. The math really, it doesn't change. Now, importantly, in this era, what goes? Obsolete or severely weakened quarter by quarter growth analysis. It's too slow. AI compresses these time constraints. You need month by month or real-time metrics now. Backward-looking quarterly financials are increasingly stale by the time they're published. Traditional runway length kind of assumptions. 10-year runways probably collapse to 3. Geographic expansion is less valuable. AI is borderless from day one. Linear TAM analysis breaks down, honestly, kind of completely. So let's go into what adapts. Fundamental shifts required. Moat durability transforms completely. Data network effects now matter more than brand or scale. Compute access, that's what really creates moats. GPU, supply contracts, and energy partnerships. Switching cost now include AI integration depth. How embedded is the AI in customer workflows? Process moats, dead. AI automates those. The critical question becomes, is this moat AI proof, or does AI commoditize it, so to speak? Supply demand dynamic shift. New supply constraints honestly emerge. Compute bottlenecks, energy availability, inference cost curves matter more than Moore's law really ever did. Network effects accelerate faster, but can also fragment faster. Watch carefully. AI either breaks monopolies or creates unprecedented winner-take-all dynamics. I also think that the risk frameworks need to expand. Add AI displacement risk as a category one existential threat. Add commoditization speed. How fast can AI replicate this capability? Add inference cost exposure. Does falling AI cost help or hurt this business? New regulatory risk around AI usage and training data. Now, there also is the what's new in this era. Emerging principles, AI leverage ratio. Listen to me. Revenue per employee should be going exponential. How much value does AI unlock per dollar invested? Are you seeing operating leverage on steroids, or is this the company trapped kind of in an AI cost spiral? Inference economics. What's the gross margin sensitivity to compute cost? Are cost per query trends improving or worsening? Is energy access becoming a moat component? How about data moat quality? Proprietary data beats public internet data. Does the product create reinforcement loops? Does usage generate better training data? Are there permission or licensing moats around that data access? Now, also an important one, and again new, though I hinted at it, is speed to adapt. Can the culture rewire in real time? What's the AI integration or debt across operations? Is this AI native, or really you're going to notice a lot more AI bolted on? Human AI complementary, so to speak. Where does human judgment remain essential? What becomes more valuable as AI handles work that is kind of commoditized? How about things like taste, curation, strategy? These roles, for now, are actually elevated. So now I have what I call the revised decision matrix when I look at individual stocks. Again, we're talking really public companies here, of course. Here's how I rate potential investments on kind of, again, back to that scale of 1 to 10. The AI proof moat strength. Can AI commoditize this? Cash generation quality, unchanged. AI era runway, compressed timelines, new adjacencies. Compute data networking positioning, new supply constraints, real-time growth quality, faster than quarterly. Capital allocation plus AI deployment capability. Management AI era judgment. Adaption speed. Risk-adjusted return versus alternatives, unchanged. AI leverage ratio, what did I just say? Revenue per employee trajectory. Commoditization resistance. How fast can AI replicate this? We're not done yet. There's a core insight here. Here's the fundamental shifts. We're moving from a durable competitive advantages to compounding adaptive advantages. Winners accumulate data, compute, and network effects faster than competitors can AI copy them. Losers will have static moats that AI can simply obliterate, really learn and replicate. The new question, and there is a new question that you must ask within every investment, and this may be the most important part of my video, my video here, relative to investing in this new era. Drum roll. Does this business get stronger or weaker as AI gets 10x better next year? Because that's not hypothetical. That is simply the world that we're living in. The frameworks that worked over the past 50, 60 years, some of them, as we referenced, still apply, but many are about to become obsolete. The investors who adapt, like in anything, not the strongest, those who adapt, their mental models now will compound wealth over the next decade. Those who don't will watch their portfolios simply get disrupted along with simply the companies that they own. And in real simple terms, my friend, that's the game that we're playing. And if we're going to be playing a game, let's understand the rules and be keeping our eyes wide open. So again, like many of you, I'm an investor, I'm an allocator. Of course, I have an investment policy statement. Of course, I choose an asset allocation strategy, which I sometimes veer off of. Hey, I'm human. But that framework or frameworks, more than one, is valuable to me. But in my choices of investing, which are often public companies, but I'm active in crypto and gold and some privates, I may consider more interest and controlling interest in private companies. I have not been as active in real estate, but I get it. Many millionaires and very rich people are. And if you understand the nuances of local markets, I think it has served you for tax advantages very well. But I do think that times are changing. And again, this is simply a new era. So for me to talk to incredible investors, to break down the metrics that we look at, and by the way, I name 9, like there's some copper to gold ratio, there's so many, there's 50, 60, 70 or more. I chose 9 that have served me and other investors well in the past. That doesn't mean that's going to continue, where again, AI is intelligence. AI is going to be horizontal. It's going to be a part of everything. Whether you like it or not, I don't care. That doesn't matter. I'm just talking realities. And all of this, again, ChatGPT launched 3 years ago. 3 years ago, look where we are now with Gemini 3. Incredible. What's going to happen in 6 months and a year? What's going to happen? Again, SaaS companies are going to be toast. I'm creating my own incredible apps for investing, CRMs and other things, and risk mitigation that I'm doing in a family office. AI agents are working for me 24/7, 168 hours a week. I go from 1 to 2, to 10 to 50? That's like having a team that a decabillionaire family office would need to have, without having the interoffice politics, romances, headaches, and all sorts of things that could go wrong. Now, I get it. Superstars are underrated. You could take that quote from me. We're all taught, oh, we don't need superstars in the family office, kumbaya, we're part of a team. Like, that's not good enough. Like, superstars are incredibly valuable. Do you have them? Are you recruiting them? Are you retaining them? Are you giving them some level of freedom to be the incredible talent that they are? And AI is going to augment all this. We're not onboarding as many younger people out of college anymore. So like, how are they going to even get training? Can't all do this virtual. You need that water cooler effect. But AI is changing everything that you know. And if you think that you're going to stick to the old models that have worked, and that's going to continue to work in the relatively near future, you are wrong. The banks you listen to, the economists, many of them, come on, they're outdated, they're conflicted. Many of them are older. They're just not comfortable with technology. They don't understand it. It's as simple as that. And this is very different than the Industrial Revolution, other things that have happened in the past. This is the intelligence layer, turning energy is converting to intelligence. The impact on this, on what public and private companies on the world is going to be staggering. Staggering. Now, many of you know I have been very, very active in AI and putting my money where my mouth is and living through it. But I haven't done as much on breaking down kind of a framework from an investing perspective, at least in public companies, that I did today. And I'm excited to do this. And even in the coming weeks, having great guests on where we could talk about the impact of this and name some actual public companies. And of course, very interested in privates as well. This is a really, really interesting time. And I'm afraid many of you are going to get simply caught in the crosshairs and be outdated. And what's going to happen to your portfolios? What's going to happen in a world when AI is going to have intelligence levels of IQ that is going to be unfathomable? Like if Einstein's IQ was 160, what happens in 2 or 3 years when AI is 400 plus and there's thousands of them, then millions of them running around? Like we're in for, this is a seismic shift. Investors and family offices, you have to wake up. Like if you're not, stop looking for people that are your gatekeepers and simply kissing your butt. You need to have these conversations, these confrontations, and facing reality. And if you disagree, to combat it, to form your thesis, at least have an informed decision moving forward. Yeah, I'm talking about this with some passion because I'm very passionate about it. And I feel that many of you just simply don't get it. Period. Now, those members of my private intelligence and strategy community, my private membership organization, SFO Continuity, not only do they get 24/7 access effectively to me, they get my proprietary insight. When I mention there's certain things I'm looking at and allocated to, we just have that conversation and then go back and forth. And they want to be introduced to someone within the network, whether a fellow allocator, investor, or someone who's a thought leader that I know, because apparently maybe I didn't get through or they didn't get it. I'm happy to make that intro. They get the opportunity to meet in person in New York, Cayman Islands, Vienna, Palm Beach, Miami, LA, and interact with some of the world's greatest investors and families as we throw these difficult conversations on the table. We actively look to debate. I look to actively yell at people, of course, and get yelled at back. And bro hug, of course, at the end. And hopefully not get anchored, but have an opportunity to learn. We all live in our own echo chambers to a degree, even when I try to fight it. I am telling you, so many of you, it's well above 70 to 80%. You don't get it yet. I mentioned last night some hyper IQ people, part of my family, I hosted over Thanksgiving. They don't even know what Anthropic and other platforms are. It's, AI is just like a little chat thing on this chat GPT, like what, 4? 4, that's outdated. Come on, brother, we're already at 5. That was months ago. Months ago. And Gemini 3 is the new king now. But there's certain things, well, I don't know. Anthropic, Claude, Sonnet, Opus 4.5, what Grok's doing with their Grok 4 Heavy. You got to understand this. You got to know how to use it. But of course, the majority of you were not a part of my AI masterclass. The mastery in learning which program to use and how to prompt and how to develop your own sovereign AI, how to structure that so you're not bleeding your IP, training the more public-facing platforms. Again, I could do it, you could do it. It's easy. And then working with AI agents, having 168 hours a week from one AI agent and understanding how to do that. Like, you think this is going to roll backwards? You think we're not in a Cold War with China? Where are you getting these assumptions from? Unfortunately, you're getting it from the wrong people who are in their silo, maybe older, and don't quite get it. It's sad. The world is changing as you know it from an investing perspective. It doesn't mean it's going to be fun and rosy. It's going to be challenging, which is why I want you to be aware. You have to understand that so much of what we know is changing. It's important to have your investment policy statement, your asset allocation. But how do you form a thesis on what you're investing in? What metrics are you looking at? And just because broadly investing long only over the last 40, 50 years in public equities has been great, doesn't mean that that is going to continue moving forward. It doesn't. So I want you to be a part of this community, of this strategy community, of this membership and peer connectivity. I've been in the family office community for decades. I've been wrong my fair share. I've been right, sometimes big time right. I know I am going to be correct on AI. And no, I don't think my timelines are off. They're not. And here we are. So you know what to do. Go to angelorobles.com, take a look at what we offer for membership, masterclasses, and consulting, and jump in and be a part of it. The year's not over. There's a lot to do. Again, I have programs coming up in the first quarter next year in Miami and Palm Beach. 5 days in Palm Beach. 5 incredible thought leaders, deep dives into geopolitics, macroeconomics, investing, AI, family office structures, sovereign risk. I got the 2 masterclasses that I mentioned last night coming out, sovereign risk and disaster preparedness for family offices and creating a top 1% family office. More and more on my AI family office masterclass, and my book coming in the first quarter, Family Office Playbook. My other ones, Billionaire Mastermind and 10 Things to Do in Your Family Office Right Now with AI. Yeah, I'll probably, now that my members have way early access, make them more public via Kindle and other platforms in the first quarter. But again, to understand, to get the nuances of how it works for you, the hand-holding, the customization, and that really is the whole value of a family office: privacy, control, and customization. If you can't deliver on that, then why even have a family office? If you can't be incredible and be excellent, why be mediocre in something that is taking up your time and energy and capital of a family office? Don't settle for mediocrity. Be incredible. And yes, there is a playbook. There is a framework. Some of it we've learned from incredible thinkers like Peter Drucker in practice management, and understanding now more in first principles about how to become excellent, how to define goals, and how to structure and measure your success in achieving them. And adapting in, again, such a challenging world that we're in. I gave the top 10 predictions for AI yesterday for 2026, and I was actually kind of muted and conservative. As we head into, especially late next year, into 2027 and beyond, like, everything that you know is effectively changing and changing rapidly. Okay, it's the afternoon, a little bit of, I think, light snow in the air. I don't have a cigar at hand's reach, but I got 2 more. I should have went out and got more with all the damn snow. But I am gonna rock the jacuzzi with a cigar today. I do love the snow. I like it in little spurts. It's beautiful. If it snows enough, which I don't think it is, but the next time it does, I'm going to go shoot a video outside. We'll be rocking the cowboy hat, whatever hair I got left. I don't want it to get too wet and frozen and start to fall off. We don't want that to happen. I will be doing a little trip to Wyoming relatively shortly as well. Quite an interesting next 2 months, basically rural Connecticut, Wyoming, and beautiful South Florida. So all very different and awesome in their own way. So go ahead, go to angelorobles.com and just simply join. Reach out to me, Angelo at angelorobles.com. And I always recommend it. I am cool with it. Besides your DMs and social media, you can all reach out to me on my real phone. I get some interesting text and voice messages sometimes at 203-570-2898. And by the way, whether it's text, phone call, email, DM, I am okay. I encourage active disagreement. Maybe things you also want to see moving forward on that I could begin to research and understand better and provide value back on. I have a lot of content. I hinted at some of them that I'm juggling. Family Office Playbook, Mastermind, revamping the 10 things for family offices and AI, creating and adapting into a top 1% family office, sovereign risk and disaster preparedness. I also have something I shared with members 2 days ago that I'll probably do a truncated video on maybe tomorrow. That is a lead into sovereign risk and disaster preparedness for family offices. There is so much going on. Why don't you join and be a part of the community? Thank you, everyone. I'm Angelo Robles at angelorobles.com. And again, running a private intelligence and strategy membership community for family offices, including showing my love to the right multifamily offices as well. Appreciate all of you. I hope you're having an awesome December. Oh, you'll see a lot more of me before the end of December, so stay tuned. Again, I think I even have an idea that I hinted at for tomorrow. So looking forward to that. Appreciate it. Have a great day.